Hey everyone, welcome back to KP Money Talks, where we simplify personal finance in Canada. What's up, investors? If you've been watching the markets lately, you've probably noticed something big brewing. The Federal Reserve is sitting at one of the most critical crossroads we've seen in years, and what they decide in September could either rocket your portfolio to new heights or send it tumbling down. Here's what's happening. Right now, markets are pricing in an 87% chance of a Fed rate cut this September. But here's the kicker. Some experts are saying those odds might actually be closer to 50-50. That massive disconnect between market expectations and reality, that's where fortunes are made and lost. Today, I'm going to break down everything you need to know about the September Fed meeting, show you exactly which investments could explode higher, which ones might crash and burn, and give you a complete action plan to position your portfolio no matter what the Fed decides. But first, and this is crucial, if you're watching this video right now, you're already ahead of 95% of investors who are just hoping and praying their portfolios survive whatever's coming. Hit that subscribe button and the notification bell, because we're about to dive deep into strategies that could make or break your financial future. Right now, the landscape is unlike anything we've seen before. The Federal Reserve is holding interest rates between 4.25% and 4.5%. But here's the twist. Conflicting signals are confusing Wall Street. On one side, Jerome Powell hints that rate cuts may warrant. That's not a promise, just a possibility. 2 weeks ago, his words sent stocks soaring and Treasury yields down. But he was careful. May warrant means they're keeping options open. The data? Inflation is cooling, the job market is softening, and financial conditions have tightened. Markets want easing to avoid a recession, yet GDP growth remains strong, conditions are stable, and volatility is low. So, what does this mean for your money? When markets see an 87% chance of something happening, but it's really a coin flip, expect big swings. If the Fed cuts as expected, markets might rally modestly, but if they don't, we could see a sharp sell-off. Stay alert, big moves are coming. Let's explore how past rate-cutting cycles have shaped different asset classes. Think about this. Have you noticed which investments tend to thrive during these periods? For example, growth stocks often outperform by 15% in the year after a rate cut. Real estate investments, like REITs, typically gain 12 to 18% as borrowing costs drop. Long-term bonds can become more attractive, and dividend stocks often shine as bond yields fall. Now, on the flip side, which assets tend to struggle? Bank stocks may see margins squeezed and high-yield savings earn less. Short-term bonds face interest rate risks, and the dollar often weakens. So, here's a question for you. When you see rate cuts, do you instinctively think it's good news? Or do you wonder if it might be a warning sign? For example, in 2019, the Fed cut rates 3 times and markets initially cheered until early 2020 when everything changed. Or consider 2007, 2008. Rate cuts didn't prevent the crash, they were a response to it. All right, let's get tactical. I'm going to break down exactly how different sectors and asset classes could perform under 3 scenarios: no cut, modest cut, and aggressive cutting cycle. Scenario 1. The Fed holds rates, 15 to 20% probability. If the Federal Reserve holds interest rates steady, here's what you need to know. Banks like JP Morgan and Bank of America could jump 5 to 10% in a single day. The dollar, measured by DXY, might spike, boosting dollar strength plays. Short-term treasuries with yields over 5% suddenly look very attractive. If you're sitting in cash or CDs, you could enjoy guaranteed returns. But be aware, growth tech stocks with high valuations might get crushed. Real estate investment trusts could see immediate selling pressure. Utilities, which are sensitive to interest rates, could struggle, and long-term bonds might face risks from rising duration. Stay informed so you can make smart decisions in this environment. Scenario 2. Modest 0.25% cut. A 65% probability. If the Fed cuts rates by 0.25% with a 60 to 65% chance, markets might not react strongly because this is what everyone expects. But here's where the smart money is positioning. Large cap tech like Apple, Microsoft, and Google could benefit as lower rates boost their valuations. Consumer discretionary stocks may see a lift as borrowing costs drop, encouraging more spending. Small caps are more sensitive to rate changes and could see gains. International stocks, especially in emerging markets, might attract capital flows. Keep an eye on sectors to watch out for. Banks could see slight margin compression. Insurance companies may face lower yields on new investments, and cash holdings like money market funds will start earning less. Stay informed and watch how these shifts could impact your investments. Scenario 3, aggressive cutting cycle. 20% probability. If the Fed cuts interest rates by 0.5% in September and signals more cuts ahead, a major shift could happen. High-growth tech stocks like software, biotech, and disruptive technology could surge. Real estate investment trusts, or REITs, may become incredibly attractive. Gold and silver could explode higher as precious metals rally. Long-duration bonds, especially 20 to 30-year treasuries, might see massive gains. But there's a warning. This scenario suggests economic trouble. The Fed only cuts aggressively when problems are brewing. During this time, quality becomes crucial. Focus on companies with strong balance sheets. Volatility will spike, so prepare for wild swings. Now, let me share some specific investment moves institutional investors are making right now. These are opportunities you can leverage to benefit. Are you ready to make smarter investment choices? Let's explore some key strategies together. First, consider the barbell strategy. Keep some cash in high-yield savings and invest others in long-duration assets. Next, focus on quality growth. Companies with pricing power and strong margins that can weather any storm. Don't forget international diversification. Spreading your investments beyond the U.S. helps reduce risk. And for some peace of mind, allocate a small portion to defensive hedges like volatility plays. Now, here's what I'm watching right now. Remember, this isn't financial advice, just my radar. Technology select. SPDR, XLK for broad tech exposure. Vanguard Real Estate ETF, VNQ for REIT opportunities. iShares 20+ year treasury, TLT for duration plays, and SPDR Gold Shares, GLD, as a hedge against inflation and devaluation. Which of these strategies or assets resonate with you? Let me know in the comments. Let's discuss the risks nobody's talking about. Now, here's where I need to be completely honest with you, because while everyone's focused on the potential upside of rate cuts, there are some serious risks that most analysts aren't discussing. Risk 1. The recession signal. When the Fed starts cutting rates, it's often because they see economic trouble ahead that we don't. Remember, they have access to data we won't see for weeks or months. Aggressive rate cuts could signal that a recession is more likely than the market thinks. Risk 2, the inflation comeback. Here's what keeps me up at night. What if cutting rates reignites inflation? We've seen this movie before in the 1970s. Cut rates too early and you might need to raise them even more aggressively later. That would be catastrophic for markets. Risk 3, the asset bubble. Risk. Lower rates could inflate asset bubbles even further. Look at housing prices, stock valuations, crypto. We're already in expensive territory. More cheap money could create bubbles that eventually burst. Risk 4, the political factor. Here's something most people forget. We have President Trump calling for 3 percentage points of cuts, and Treasury Secretary Bessent suggesting rates should be 1.5 points lower. Political pressure on the Fed could lead to policy mistakes. Risk 5, the global factor. The U.S. doesn't operate in a vacuum. If other central banks aren't cutting, and we cut aggressively, we could see massive dollar weakness, which brings its own set of problems. These risks are real and smart investors need to be prepared. Now, how to protect yourself? Don't go all in on any single scenario. Diversification isn't just about different stocks. It's about different economic outcomes. Keep some powder dry. Cash isn't trash if everyone else is over-leveraged. Focus on quality. In uncertain times, strong companies survive and thrive. Have an exit strategy. Know what would make you change your mind. Here's my personal approach, and again, this isn't advice, just transparency about my thinking. I'm positioned for modest rate cuts but hedged against the scenarios where I'm wrong. Now, what should be your action plan? Let's get practical. Here's your step-by-step action plan for positioning yourself before, during, and after the September Fed meeting. Before the meeting, now through September 16th. Step 1. Portfolio health check. Review your current asset allocation. Are you too concentrated in rate-sensitive sectors? Do you have enough diversification across scenarios? How much cash are you holding? Step 2. Implement a base case strategy. My base case is a 0.25% cut with signals of gradual easing. Here's how to position for that. Core holdings, 60 to 70% of portfolio. Large cap U.S. stocks with global exposure, investment-grade bonds with mixed duration, a small allocation to international developed markets. Tactical positions, 20 to 30% of portfolio. Small cap value stocks, rate cuts help these disproportionately. REITs focused on data centers and healthcare properties. Technology stocks with strong free cash flow hedges, 5 to 10% of portfolio.
Some long-term treasury bonds, a small precious metals allocation. Keep some cash for opportunities. Step 3. Set your alerts. Monitor the 10-year treasury yield, key technical levels. Watch the dollar index, DXY. Keep an eye on bank stock performance. Set price alerts on your key holdings. During the meeting, September 16th, 17, the Fed announces at 2 p.m. ET on Wednesday, September 17th. Here's how to trade the announcement. If they cut 0.25% as expected, look for initial relief rally. Watch for sector rotation into rate-sensitive areas. Consider taking some profits on defensive positions. If they hold rates, expect immediate market volatility. Look for opportunities in oversold quality names. Consider adding to cash positions. If they cut 0.5% or signal aggressive easing, this is the recession fear scenario. Focus on quality over quantity. Consider adding defensive hedges.
After the meeting, next 30 to 60 days. Week 1. Let the dust settle. Don't make major moves immediately. Watch how different sectors react. Pay attention to what the Fed actually says, not just what they do. Weeks 2 to 4, position for the new regime. If cuts are coming, start rotating toward beneficiaries. If they're holding tight, focus on value and cash flow. Rebalance based on what actually happened. Values expectations. Months 2 to 3, fine-tune your strategy. Monitor economic data for confirmation. Adjust international allocations based on dollar strength. Consider tax implications of any moves. That's a complete 60-day roadmap. Patience, positioning, fine-tuning. If you found this video helpful, be sure to like and subscribe for more market insights. Stay tuned for our upcoming deep dives, including the top stocks that could double in a rate-cutting environment. Remember, investing is a marathon. Stay informed, stay diversified, and stay disciplined. Thanks for watching, and we'll see you in the next video.